The Chinese equity market has depreciated 15% in local currency terms year to date. The trade war continues to escalate, as does Washington's shifting perception of China, indicating a new era of adversarial US-Sino relations where China is no longer a strategic partner, but a rising competitive power intent on US hegemonic decline. Whilst hope remains that when Trump and Xi meet in late November at the G20 summit, a deal may be struck, the probability of this outcome seems low, given the marked deterioration in US-Sino diplomatic dialogue and the increasing probability of a Cold War unfolding fought through technological supremacy. So where does this leave Chinese equities? Given the large declines that have already been seen in Chinese equities year to date, one could argue that the growth slowdown and adverse economic impact of the trade war has already been priced in, leaving limited downside risk. The question remains, will policy easing be enough of a positive catalyst to outweigh the tariff headwinds? As China's growth momentum has slowed and deleveraging started to bite, the Chinese government has stepped in to mitigate the effects of the trade war, showing limited willingness to stomach lower growth given the elevated growth targets that have been set. The policy shifts have stabilised credit growth, pushing China's credit impulse back into positive territory. This easing bias is likely to be maintained in Q4 with another RRR cut and targeted fiscal stimulus aimed at supporting exporters. Although the policy efforts introduced so far do not amount to broad-based easing as previously seen, these measures should not be underestimated, as they signal Beijing's readiness to support the economy and the potential marginal impact can support the market. Since China commenced on the path to economic reform, it has ensured its current position as one of the largest developing countries in the world with remarkable speed. For investors, the short-term noise should not detract from the long-term opportunity. China's path to future growth and prosperity, as outlined in the ambitious industrial strategies laid out by China's State Council, is one that investors should not ignore. Whether or not the autocratic official targets or ambitions of technological independence are met, the underlying demographics and market conditions are aligned for an undeniable transition to a domestically focused, service-based economy with increasing technological advancement, presenting an opportunity for investors to seize China's new economy.